talk a little bit now about what does this mean for the insurance industry, and starting with what it means for AIG's insurance companies. Well, they are heavily regulated by the state insurance departments. And the good news is that these insurance companies are separate companies with separate balance sheets and operations. And there is no direct connection with credit default swaps with or the financial products division of AIG. Now, the life insurance companies were invested in residential mortgage-backed securities, so there was exposure to the life insurance companies, which lost money when those securities collapsed. But otherwise, the state regulators are adamant that they will protect the insurance companies' surpluses and the ability of the insurance companies to pay claims. And in fact, as of now, the property and casualty insurers have about $26 billion in combined surplus, which is available to pay claims. So from that standpoint, the insurance companies remain solvent and stable companies. Now, the bad news is, or the potentially troubling news is, if you turn to slide number 13, is the fact that AIG's insurance companies have traditionally had a very close relationship with the parent company, and in fact, their performance from a ratings perspective, in terms of their credit rating and their rating as insurance companies, has been tied very much to the performance and stability of the parent company. In fact, AM Best has stated that the implicit or explicit support of a parent or affiliate can affect an insurer's financial strength and therefore its best rating. And we see how that can be of a benefit to an insurance company, for example, in 2005 when AIG infused about $3.7 billion into its insurance companies. And of course, that money can flow the other way in certain circumstances where the AIG insurance companies have upstreamed about $5.3 billion in dividends to the parent. So this reliance and on the strength of the parent obviously is troubling in a situation where the parent is basically struggling for its very existence, and its financial situation is in such a difficult and negative state. Now, if we turn to slide number 14, we'll see that the AIG insurance companies also have a close relationship with each other. Their current rating is an A with negative implications, which means that the rating agencies, considering all of the relationship with the parent's financial difficulties, and the interrelationships amongst the insurance companies, the negative implications means that they're still considering whether or not further downgrades will be necessary. What I mean when I say that they have a close relationship with each other is that there are these intercompany pooling arrangements where basically the AIG property and casualty insurance companies reinsure each other. The insurance companies in the commercial pool, for example, which consists of National Union, American Home, Insurance Company of the State of Pennsylvania, Granite State, American International, South, Commerce and Industry Insurance Company, AIG Casualty, New Hampshire, and Illinois National, they all provide varying levels of reinsurance to each other within that pool. And similarly within the surplus lines pool, which is Lexington, Landmark, and AIG Excess Liability. What that means is that the financial performances of the companies within each pool are tied together to a certain extent because the fact that losses from one company will be felt by the other companies to the extent that they reinsure the first company. And as a result, for example, AM Best typically rates all of the insurance companies in the same pool with the same rating to reflect the interrelationship and the financial performance being tied together. Now, there's not a lot of transparency in the reinsurance agreements themselves. It's a fairly closely guarded set of contracts by AIG. At least one analyst believes that there's a significant risk in the reinsurance pools because he's not convinced that there's enough that some of the insurance companies may be overextended by the amount of reinsurance that they have provided to the other companies. But AIG very strongly disputes this, and it's worth pointing out that the state insurance regulators have known about these reinsurance relationships for a long time, obviously, and have allowed them to continue to operate. Recently, if you turn to slide number 15, recent performance of the property and casualty insurance companies is there have been some losses. Their net premiums are down from last year. And interestingly enough, two of the subsidiaries, that's National Union and American Home, account for over 65% of the total policyholder surplus of $26 billion, and they account for nearly half of the net written premiums. So those companies would appear to be much more strongly capitalized and much more in a much better financial situation than some of the other subsidiaries. And it's these same two subsidiaries that reinsure the others in the commercial pool. There's also been noted a recent loss of customers as reflected in the net premiums being down, as well as employees who have left the insurance companies, including employees in some key areas fairly high up, for example, in the organizations, which is of some concern to the ongoing operations and viability of the insurance companies. So if you turn to slide number 16, again, the AIG's intent here is to spin off the insurers into their own holding company, AIU Holdings. But the question is, how will this entity operate without the financial backing of AIG? I mean, if AIG is not there as the parent company to provide financial strength and stability to the insurance companies, will that affect their ratings? Right now, the rating agencies are relying on the fact that the U.S. government essentially is supporting AIG's financial position, which is in turn, at least in part, supporting the financial position of the insurance companies. But when you spin off those insurance companies into their own entity, the government's backing is not going to be there. The parent company's backing is not going to be there. They're going to have to stand on their own with the assets and the capital that the insurance companies have. So, how will insurance buyers perceive this new entity? Will they have the same confidence that they had in the old AIG-backed insurance companies? That remains to be seen. Certainly, I would think that AIU Holdings is going to have some job to sell itself and to sell its operations and its insurance to policyholders on a going forward basis to convince people that they are in fact going to be successful. But another question is, when is that going to happen? They've announced that they would like to spin off AIU into its own company, its own holding company. But they haven't announced a timetable for that. So we'll have to see how it goes. In the meantime, of course, they continue to, the parent company continues to lose money and continues to be reliant on the government. Question also remains whether or not AIG will be able to repay the federal loans even under the new 5-year plan. AIG's had trouble selling its assets. It's in a weak bargaining position. Everybody knows that they have to sell. Maybe they'll end up having to sell AIU Holdings to raise the cash necessary to pay off the loan. Who knows? I mean, they've already indicated that they would like to sell a minority stake in AIU Holdings and make a public offering of shares. Whether that's going to be sufficient to raise enough cash to pay off the loans is again another unknown question that remains to be answered.